Hi, I'm Grant Stephen, one of the two investment guys. Chris is away this week, but I have a very special guest in Dr. Warren Jestin, who is Senior Vice President and Chief Economist for Scotiabank. He's going to share with us today his views around the global economic stage and some of the factors that are driving the data. Warren, I wanted to start, if I could, just by asking you what you see on the horizon for 2014 in the global economy.
Well, the outlook's pretty constructive. The U.S. economy is finally coming back. Americans are buying more cars. Their housing market is coming back, which for BC is good news in lumber exports and the like. Asia is slowing down a little bit, but it's hard to get really worried when China's still growing over 7%. It should be reasonably good for commodity prices. And Europe is coming out of the longest recession since the formation of the Eurozone. So the news is better. It's not great, but directionally, we'll take it.
So if I could turn to Canada then, just some news out of the Bank of Canada yesterday with respect to their expectations around the Canadian economy and low inflation, and it sounded to me like bumping out raising interest rates for another year anyway. I wonder if you could just comment on that.
Well, I think Governor Polis has done a couple of things. One, has really focused on the inflation side, and everywhere it seems inflation is relatively low, and in Canada it's at the low end of their target range, and he's saying that range matters, and he's looking for something to go much more to the mid-range, about 2%. Right. But also he has indicated that going forward, rates are probably going to stay where they are right now for a while, but they could go up or down. And that news, of course, has had an implication for our currency markets, and one of the reasons why the Canadian dollar has tended to be softer.
Right. So actually very topical, the Canadian dollar these days. It seemed to me that it took a while to grind from par down to 95, but it sure didn't take very long to get to 95 to 90 cents or so today. What are the biggest influences there right now?
Well, there's a lot of them. The Canadian dollar is a commodity currency. Commodity prices are pretty good, but they haven't been having much in the way of upward momentum. There's uncertainty about pipelines, and of course that's a big export for Canada. The Bank of Canada has changed policy slightly so that people think indeed it may well be the next move down as opposed to up in terms of interest rates. And we also had a statement which was very interesting in the Bank of Canada statement yesterday, which indicated that even at 91.5, which was where it was, the currency was still strong. So the signals, whether it's the innuendo or whether it's the economic performance of the U.S. being stronger or commodities not going up in the way they were in the past, all have tended to take the air out of the Canadian dollar, and we think it'll probably end up in the low 90s and may stay in the low 80s for a few months.
Right.
Or high 80s, not low 80s.
Sounds like quite a few moving parts there.
Oh, yes.
Thank you very much for your time today. Join us next time. Chris will be back, and we will carry on with our discussions around the capital markets and some of the things that we're seeing then. So until then, I'm Grant Stevens signing off for the Two Investment Guys.